prepare the slide. And when I prepared this webinar, I didn't know that we're going to have another small slide today. But basically, we're in the same range we've seen last week, and there's no new 8-month low. Okay, so let's begin. My name is Yohay Elam. I used to be a retail trader and a computer programmer. I founded Forex Crunch back in 2008. The focus of the site is on fundamental analysis. I do touch on technical analysis more for entry points and things like that, but what I focus on is news, opinions, what actually moves markets, and that's fundamentals. Okay, this is what we'll cover today. What led to the recent slide in euro-dollar? We'll do a rundown of the recent US data, mostly from last week. We'll talk about the state of the Fed, and then move to the Eurozone. Current economic situation in the Eurozone, good, bad, and ugly. And we'll do an ECB preview. That's the main event of this week, coming on Thursday. And of course, as always, there will be enough time for questions and answers. So, current situation in euro-dollar. This is how the chart looks like. We have a slide from 140, nearly 140 in May, and the recent slide is what we'll talk about soon. We can see downtrend lines, resistance and support. They're not parallel, but they do give some reference and give some proportions on this slide. So here are the lines as well. From top to bottom, 135.50, 135, 134.50, 134, 133.65, which is the recent low. And then we have lines that date back to last year, 133.25 and 132.95, which is the critical line, the November 2013 low. Let's talk about what made this move. So it's basically all about the United States. Good US data, stronger dollar, and euro-dollar is falling. So the main driver has been the US in the recent fall in euro-dollar and not the euro. Let's talk about the data. So last week we had GDP growth for the second quarter. It came out at a great figure of 4%, an annualized figure, of course. We also had a nice revision for the first quarter. Instead of a contraction of 2.9, we had 2.1%. In addition, we have solid job growth. This is seen from payrolls. Jobless claims average, weekly jobless claims, 4-week moving average is under 300,000, which is great. Last seen many years ago. We'll dive into that more in detail soon. The strong PMIs, we have the ISM non-manufacturing PMI right after this webinar. Markets number has been strong, 60 plus points, but ISM still carries more weight in markets. We've seen a gradual tick up in inflation, 2% core CPI, but we'll talk about what inflation is important. And we have the Fed gradually acknowledging an improvement in the US economy. So this all leads to high rate hike expectations. We have more hawkish talk from Fed speakers, not from Yellen herself, but from others, and more analysts, Fed watchers, such as John Hilsenrath in the Wall Street Journal or Steve Beckner from MNI, beginning to talk more and more about the inevitable rate hike. We've also seen rate hike worries in stock markets. We've seen them a bit more jittery. We've seen a fall last Thursday. All in all, stock markets are hesitating about to continue moving up or go down. So far, we haven't seen a crash. Volatility is low also in stock markets. Let's focus on the Nonfarm payrolls, the last big event from the United States. It came out on Friday. It came out only at 209,000. And we've seen no wage growth, only remained flat at 0. Expectations were for 0.2%. And most importantly, we had a take profit on the dollar. We've seen the dollar surge across the board last week on the GDP numbers, on jobless claims, on a small shift from the Fed, on rate hike expectations, all that hype. And on Friday, we had a small miss, 209 instead of 230, and the eventual result was the sell-off of the dollar. As we're seeing it today, in the euro dollar, for example, we see the euro dollar fall without any particular reason back down under 134. So this seems more and more like a take profit move, the reaction to the non-farm payrolls. State of the Fed. The Federal Reserve, Janet Yellen, they're on course to taper each meeting by 10 billion. So far we had 6 tapers, a 7th one is coming in September, and the last taper will be of 15 billion in October. That will be the end of quantitative easing, QE3. The big question, as aforementioned, is rate hikes. When will they come? Growth. The Fed anticipates 2.2% growth in 2014. That's a median estimate. After the recent GDP figures, it looks more realistic. I think we'll have in the second half of the year a growth rate of 2.5%, 3%, which will be satisfactory, not exciting, but good enough for an ongoing steady recovery of the US economy. Moving on to employment, we had 6 consecutive months of gains over 200,000. It's the best 6 months since 1997. That's a long time, that's 17 years ago. Jobless claims, the record low was 279,000. That was 2 weeks ago. It's the lowest since 2006, at the height of the boom, well before the bust. And continuing claims, another related figure, down to 2.5 million. What's more important is to look at what figures interest the Federal Reserve. So we have the jobs, it's the job openings. It's a laggy figure. It refers to the previous month. I mean, in a week or so, we'll get the jobs figure for June, not for July, like the non-farm payrolls. But in any case, these figures are very strong. Recently, jobs jumped to 4.65 million in May. Bernanke mentioned it as important, and also Yellen, which is very similar in her views to Bernanke, also mentioned that. Inflation. During many years after the financial crisis, inflation was irrelevant, but recently it became more important towards potential rate hike, because the main goal of most central banks in the world is containing inflation, not taking care of growth or jobs. Fed does have a dual mandate of full employment and low inflation, but inflation seemed out of the radar. So the Fed doesn't like CPI, Consumer Price Index, and it doesn't like also core CPI. Its preferred measure, according to Yellen herself, is the core PCE price index. This is a certain basket of products that is more related to what consumers actually buy. It's currently 1.6% on an annual basis, a year-over-year basis, and it's gradually moving up. We'll need to see it rise above 2% in order to make the Fed a little bit more anxious. Okay, so now the big question is also in inflation is, where's the money? In normal times, the interest tool was used to affect the demand. So if you have steaming hot economy and you don't want inflation, as a central bank, you raise the interest rate, and this means people will save more money and lend less money, because lending becomes more expensive and savings gives you more in benefits. So you don't, as a consumer, you consume less. So it affects demand. But recently, despite all the job gains, despite 6 months of job gains that were the best since 1997, salaries remain low. There's still a lot of slack in the economy, as the Fed and the Bank of England say. They really like this word. Okay, so we have more jobs, but less offers. Basically, there's a gap between job growth and salaries. Eventually, as the economy does improve, more discouraged people will return. We currently have a participation rate of 62.9. It's off the lows of 62.8, but it's still the lowest levels. I mean, these levels were last seen in 1978, 36 years ago. Salaries have been pushed down after the crisis, and each time that people stop being discouraged and come back to the job market, they actually push salaries down. So average hourly earnings, wages, salaries have gone up 2% year over year. That's in line with inflation, nothing exciting. We have to see a rise towards 3% to make the Fed anxious about inflation, and together with the core PCE price index I mentioned before, and to begin talking about interest rates. So that's the state of the Fed. So current market expectations are that a rate hike will come in mid-2015, around this time next year, maybe July. But it could come earlier if salaries begin to rise and the core PCE price index begins to rise. And here are dates which we should look out for in the near future. The Jackson Hole Symposium, it's held in Jackson Hole, Wyoming. It's an important conference of central bankers. It's held towards the end of the month. We might hear from Yellen about future rate hikes, some kind of hint, but I think she'll be a bit cautious. In addition, we have the revised GDP figure. Recently, we've seen huge fluctuations in revisions. So this will be on August 28th. And the most important event in the near future is the September meeting of the Fed, September 17th. We'll have updated forecasts from FOMC members about inflation, employment, growth, everything, and a press conference where reporters will probably ask Yellen tough questions. My personal bet on a rate hike is that it'll come a little bit earlier than markets expect. March 2015, there's a meeting on that date, and it consists of a press conference as well. I think by then figures will improve in a manner that will allow the Fed to move on rate hikes. But of course, everything depends on the data. So, wrong slide. Now to crossing the Atlantic to Europe. So, here in Europe, we can describe the situation as fragile recovery. I didn't invent this phrase. It's Mario Draghi. So, Eurozone economies are growing, but quite slowly, and it's sort of vulnerable. So these are the good things in the Eurozone. Unemployment is grinding lower. It fell to 11.5%. It was over 12% a few months ago. Banks are more willing to lend. Finally, we're beginning to see the measures of the ECB reach the real economy. Small personal anecdote. Was asking around in my bank about what's going on, and they told me that now if they want to take a personal loan for buying a car, which I don't want, of course, but I don't like it. But I would have to pay an interest rate of only 5%, contrary to 9% just a few months ago. And it also seems, apart from unemployment grinding lower and banks more willing to lend, that the recession is not around the corner. So there is some kind of stabilization. But not everything is good. Germany had a strong growth rate in the first quarter, 0.8%. And now we're seeing a slowdown. All signs point to a slowdown. There's lower business confidence in Germany. There's still rising unemployment in France. So while unemployment is falling in many countries, including here in Spain, where I'm based, it is rising in France, Europe's number 2 economy. And there's still pockets of deflation. We'll dive into deflation soon. Specifically here in Spain, prices have fallen by 0.3% year over year. And that's, of course, scary for the ECB. We'll talk about that soon. The ugly, the good, the bad, and the ugly is geopolitics. There's fear of Russia. We won't dive into the whole politics of the Ukraine crisis, but basically Europe and the United States put sanctions on Russia. These sanctions were answered by counter sanctions. So far, gas supply to Europe is stable. Germany relies heavily on gas supply from Russia. The fear that this could be cut or that relations could be severed is a bit scary for everybody. This is sort of black swan, if you wish. Another issue is the bank bailout in Portugal. So, so far the situation is contained. Banco Espírito Santo ran into trouble, was bailed out by the government and the central bank in Portugal. a local crisis. On the other hand, it showed that a problem nobody knew about a few weeks ago suddenly emerged and became an issue. And they quickly needed a resolution. So the AQR, the Asset Quality Review of the European Central Bank, the stress test, might look a bit more problematic. The ECB might not exactly know what the situation of the banks is, and we could still have sort of flashbacks from the European debt crisis that seemed to be behind us. So not everything is really good in Europe. Okay, now let's move to the European Central Bank. It did a monetary blitz back in June. 0.15% is the current interest rate. There's a negative deposit rate. That's a historic move from a major central bank. Basically, banks are punished for depositing money with the ECB. They're sort of encouraged to lend. And as I've mentioned before, it seems to bear some fruit. We're finally seeing some lending to the real economy. What else did the ECB do? Well, it stopped the sterilization of the S&P bond buy. This is a legacy program of the ECB dating back to 2010. It means more money is available to money markets. And more interesting move is targeted loans, what was called in the UK funding for lending. That means banks will get cheap loans only if they lend it to the real economy. This will begin to be implemented in September, some months from now. And later on, not in that press conference, Draghi made a heavy hint that interest rates will stay low until the end of 2016. This is well after a rate hike in the United States is expected, or in the UK, and even Australia might, and Canada might hike before that. Only Japan will probably stay behind. So basically, the ECB is one of the more dovish central banks. What the problem was, what Draghi didn't do correctly, in my opinion, during that press conference back in June, is that he changed forward guidance, basically saying that rates have reached their lower bound. Well, it's hard to cut deeper below zero, but anyway, it sort of balanced his other actions and allowed the euro-dollar to temporarily recover. Some sources later reopened the door to even deeper rate cuts, so it's still on the agenda, in theory. We'll talk about that soon in more detail. So, the European Central Bank has one target only, single needle in its compass, an inflation target of 2% or a bit below. The target is being missed month after month. Low inflation means that the debt burden on European countries is heavier, and the D word, deflation. So, quick talk about deflation. When prices fall, it seems to be good because we pay less for what we buy. But then if we expect prices to fall, consumers expect them to fall, and they don't buy, factories produce less, people lose their jobs, and there's even less consumption. So the result is sort of a vicious cycle of economic depression. That's what happened during the Great Depression in the United States in the 30s. That's what happened in Japan until the recent change in policy. Lasted for around 2 decades. So falling prices is not always a good thing. So how has inflation behaved? The big fall began in October of 2013 with a fall to 0.7%. The ECB reacted immediately with the rate cut in November to 0.25%. But inflation kept on falling. It stabilized at around 0.5, 0.6%. But now the initial figures for July show 0.4%. This is really low. Core inflation, which is not officially the target of the ECB, but it's also being looked at, fell twice to 0.7. In July, it stood at 0.8, like in June. So it's not that bad, the core inflation, but it's still far away from the 2% target. Basically, the euro is weaker since May. It reached almost 140. It's currently at the lowest level since November 2013, but not low enough to push inflation lower. The dream level for the European Central Bank would be somewhere between 120 and 125. I don't think this will happen soon. But in these levels, inflation would be higher and exports would be more competitive. Now, this is important. The ECB so far denied the danger of inflation, but it did warn that if this lowflation, as it's called, stays for too long, it is dangerous. But they eventually raised the rhetoric. They explicitly connected monetary policy to the exchange rate. They did talk about the impact of the euro-dollar exchange rate, not only euro-dollar, to inflation, to the economic recovery. Eventually, they acted in June big time. So the exchange rate means the strong euro means less attractive exports, as I mentioned before, and cheaper imports, pushing inflation lower. 140 seemed to be the line in the sand in euro-dollar, but it's not only euro-dollar. World's number 2 economy, China, is a major trade partner of Europe. So at the beginning of the year, the Chinese authorities let the local currency, the yuan, fall against the US dollar. This worsened the trade terms of the Eurozone with China. Strong euro, Chinese yuan means that exports from Europe to China are less attractive and Chinese imports are cheaper, pushing inflation lower. So we have the euro still, well, it did weaken, but it's still relatively strong, and Draghi would like it to weaken more. So what will the ECB do now, in 2 days from now? Basically nothing. But because they want to see the full effect of the measures in June. But doing nothing doesn't mean saying nothing, doesn't mean not moving markets. Draghi always moves the euro, either to the upside or to the downside, but markets usually don't stay idle. They don't ignore him. So he's going to talk. What can he talk about? He can talk about 3 things. He can talk about the acceleration of work on quantitative easing, the last major tool that the ECB has. He can try to talk about the exchange rate, to talk down the euro, and he can try to reopen the door to more cuts, cutting the deposit rate even deeper in negative territory, or cutting the main lending rate from 0.15 to 0. So let's talk about these 3 things. You can wave with QE, scare the markets. QE, quantitative easing, is a huge tool. It can weigh heavily on the euro without need for action. Just the talk can weigh on the euro. Disadvantage is the ECB doesn't really know how to do it. Why? Because contrary to the United States or to the UK, there are 18 countries in the Eurozone. So what bonds do you buy? You prefer the sort of safe German bonds, or where the impact will be low, or you buy peripheral bonds and then you encourage moral hazard. So there's so many questions around that. In addition, there is no German opposition to such a move, and that would be problematic. The second option is trying to talk down the euro. So if Draghi warns more and more and escalates stock, it can work. It can push the euro down because he has a huge impact on the value of the euro. And it could say it's needed to fulfill the mandate of the ECB, which is price stability. However, the Eurozone, its member countries, are tied to the G20 accords, international agreements, which means you don't intentionally suppress the value of your currency. You don't do a beggar thy neighbor policy. So far, the ECB always said that it's not targeting the exchange rate. The exchange rate does have an impact, but it's not targeting it directly. So it'll have to maneuver around the exchange rate in a delicate manner. The third option is to reopen the door to lower rates. It seems a bit unlikely because it would be a U-turn from what they said in June, and only 2 months have passed since then. And it could also boomerang as a substitute for quantitative easing. So if you cut the rates even deeper, it means you're not going to do QE. You cannot wave with QE, which means the euro could actually rise. So what the middle ground here is that Draghi could describe a reopening of the door to more cuts, and not as a U-turn, but as small adjustments. But that's also a path that is hard to walk. So, what do we expect from the European Central Bank? I expect talk, no action. QE talk and euro rant about the value of the euro is more likely than to reopen the door to lower interest rates. What Draghi would like in an optimal scenario would be that the euro would be weaker after the press conference, without having to act, of course. But a weaker euro depends a lot more on the flows and on the Fed. So if we have strong data from the United States and the dollar strengthens across the board, it will have a stronger impact. In addition, Eurozone still has a positive trade balance in current account. It means that on a daily basis, exports via imports, there's more money flowing into the Eurozone, and this keeps the euro bid. More importantly, after Draghi sort of single-handedly saved the euro from the debt crisis, if you wish, and he raised confidence, money came into the Eurozone buying bonds that were cheap. However, these bonds are not so cheap anymore. Spain sometimes has lower yields for 10 years than the United States. So this thing seems to be over, and flows might be going out. So if the European Central Bank is lucky, we'll see some more profit-taking on peripheral bonds, such as those of Spain and Italy, and this will push the euro lower, and this could have a stronger effect than just his stock. But his stock does have a strong effect. He would like basically to have a weaker euro without having to act, leaving the work for others, but he may have to push in that direction as well, cast his weight. So, this is what I've prepared. What do you think will be the next direction of the euro? I see there are already a few questions. Let me sip some more and see what questions are. Well, I don't know if you missed anything important. Just asking a specific question. Odd retracement. Okay, Australian dollar, in my opinion, in the RBA's opinion, is also a bit too strong against the US dollar. We did see it lose the 93 level last week, but the non-farm payrolls allowed some profit taking on these shorts. I see it moving down in the longer term. We had a weak services PMI from China, and I think the RBA, which stayed still, could try to push it down a bit more, but there isn't a lot of room to go because we are seeing a bit of rebalancing in the Australian economy, moving away from mining to other sectors. It's a slow process, but so I think there is room to fall in the Aussie, but not to fall. Correction in the euro. I see basically the Fed and the ECB moving in different directions. So as I see it, in my opinion, there is room for euro dollar to fall. But it's never a one-way street. We have seen it fall from 140 to under 134. I think it's not the end of it. I don't think we'll reach the desired 120 level where it was in the summer of 2012. But 130 is realistic. On the way, we could have corrections. I think that Mario Draghi will do his best on Thursday to push it even lower. Because lower euro would help exports, would help inflation, and would pass the time while the measures of the ECB work. So we are seeing some green shoots. We are seeing, as I said, banks are lending more money. It's unclear if they have who to lend to. That's an open question. but Draghi I believe, would like a weaker euro, but on the other hand, to ask for some patience for his measures to work. That's a delicate path to walk, but I think he'll attempt to do that. Can you check Aussie USD, please? I think I answered the question, or do you have another question related to that? I think regarding the Australian dollar, we're seeing more interesting action in the Aussie Kiwi pair, Aussie Kiwi cross. It has moved quite sharply. So mostly thanks to the New Zealand dollar. New Zealand dollar, there was a series of rate hikes, 4 rate hikes from 2.5% to 3.5%. Kiwi dollar reached a double top at just under 88.40. But now the central bank in New Zealand signaled a pause, and since then the Kiwi is falling, also thanks to the strength of the US dollar. So, and if you look at the charts, we have interesting patterns on Aussie Kiwi. But let's focus a bit more on euro dollar here. This is what I'm expecting. Okay, while we wait for more questions, let me say thank you to FX Rate for hosting the webinar. You're welcome to visit Forex Punch. We have something new on the website, a podcast. It's still in test mode. We're calling it Market Movers. I'm doing it alongside my associate Your Coin from Trading Energy. It's a weekly show, audio, radio show if you wish. We're talking about the markets, one long-term topic and two short-term, what's going on in the markets. We just published a new episode today. And of course, join the newsletters, and here are other contact details if you have any more questions outside this webinar, email address, Twitter handle. And I'll just mention also that there are mobile applications for Android and iOS. No, it's not over. Asking the question, we have a few more minutes, 10 more minutes. So if you have more questions, just ask. Any view on gold? Well, if regarding the correction in Aussie dollar, I don't know. I think it has stabilized back in range. I don't know. As I mentioned before, I see it falling a little bit more. If we get good figures from the United States, push the pair lower, and weak figures from China, as we've seen today. So I see it moving more room to the downside before the upside. Regarding gold, assuming there's more tightening in the world, less printing of money from the United States and from the United Kingdom, we could see gold slide even further off of silver, but I don't think we'll see exaggerated moves, crazy moves up and down like we've seen a few years ago. I think we're seeing it sort of more comfortable in range. Cheryl. I'm basically bullish on the US dollar, but I think regarding the British pound, we have room. I think the pound made a huge correction, falling from the highs cable fell from 170, nearly 172 to nearly the bottom 168. And I think there's room for correction. There's a race sort of between the Bank of England and the Fed and who will raise the rates before. I think the Bank of England will do that before, so I think there's room for some. I can't say I'm bearish on cable, but I think there's room for the upside on cable and pound dollar. Dollar yen, I think we've seen some negative signs from Japan recently, and the Bank of Japan could hint more action. So there is a bit more room for the upside on dollar yen. The Bank of Japan is in an easing mode like the ECB, so I believe we have a bit more room for the upside, especially if US yields rise, and there's a good chance they will rise once QE ends. When do you think Forex will pick up again? That's a great question. I'm asking that myself every day. I'm frustrated by the low volatility. It reached the terrible levels in April and in June. We did see it pick up a bit in July. I think now that central banks are tightening a bit, we might see it pick up. Last time we've seen such volatility was in 2007, close to the financial crisis. I don't think we'll see that crazy action like in 2008 once again, but with high stock markets that could fall, with the tightening from central banks in the UK and the US, we could see a pickup in volatility. Hopefully we reach the bottom in June, and it's the only way is up from here, like Frank says. I didn't prepare technical levels for Aussie dollar, so I don't know where to sell, where to buy. Basically, we've seen the round number of 95 as a really strong level of resistance. I see 92.20 as sort of support in this wide range. And beforehand, the 94 level was sort of a magnet. As I said, there's room to the downside, in my opinion, but not too far. No, I'm not Spanish. I'm from Israel. I live in Spain, in Barcelona, for the past 3 years. Yeah, euro dollar barely moves 50 pips a day. It did pick up a bit, I think. It has already been worse. I'm trying to comfort myself. But, well, I think towards the end of the year, we'll see some more action in euro dollar and everywhere. I think PMI, the ISM non-manufacturing PMI could push euro dollar lower, below 133.65. We would need levels something like about 57 or I guess 58 points, and an especially strong employment component. Usually the employment component of the ISM non-manufacturing PMI is a signal for the non-farm payrolls. This time we have it after the non-farm payrolls, but it's important nevertheless, and it's a major market mover. The service sector is the biggest sector in the United States. So a strong read, which I'm not sure we'll see, but if we'll see a strong read, it could positively impact the US dollar and push euro dollar to a new low since November 2013. Thank you for the kind words, the compliments. New Zealand deployment. I think it'll rise a bit. I think it'll be relatively positive and allow the kiwi to recover. Kiwi suffered big blows from the pause that the RBNZ took, and expected tightening of the Federal Reserve in the United States. I think it's suffered too much. The economy in New Zealand is doing quite well, and we'll get a reminder of that, I believe, tomorrow evening, which will be Thursday morning in New Zealand. Or is that today? No, it's tomorrow. Any more questions? We have a few more minutes. Thank you, everybody. Everybody's frustrated about low volatility in Forex. This means website owners like myself, Forex brokers that see less trade, and of course Forex traders, which have less opportunities. I don't know if it's a buy or sell. I see potential for more losses in euro dollar, but in the long term, but it's not a one-way street. So I see it closing lower at the end of the year, but it depends on the data. If we have a weak non-manufacturing PMI from ISM in about 15, 20 minutes, it's a buy. But if we have a good ISM non-manufacturing PMI, euro dollar could break to lower levels. So this is in the very short term, the next 20 minutes, that's the biggest event impacting euro dollar. But the bigger event of this week is, of course, the ECB rate decision, which we discussed earlier. Thank you very much. It's a very nice compliment. I'm really happy. What would you recommend trading on? Well, should trade on whatever pair works best for you and try out a few pairs before focusing on less pairs. There's a section on my website I update every quarter, which I call the most predictable currency pairs. So if you're into technical trading, look into, there are some currency pairs that behave better than others. I believe usually the Australian dollar is the star. Euro pound is good. New Zealand dollar. These things change over time, but quite too often euro dollar is the world's most popular pair. I find it the most fascinating, most interesting, but not necessarily the easiest pair to trade. So I would look to the Australian New Zealand dollars and also to some crosses, the Euro Aussie, the Euro CAD. I know that the pound yen is very popular. I personally don't like it, but basically should fit your strategy, your pattern, your trading style. Less traders than last year. I don't know if less traders, but from my point of view, there's just less volatility and less growth. So if I look at the traffic on my website and what I hear from peers in the industry, there's just less action, less growth. You can see that in volumes of forex brokers such as FXCM and Gain, which are public companies, and publish their data, and you see lower volume, which means lower profits. So as far as I know, there are less traders maybe in the United States because of tough regulation joining the low volatility. But I think that globally there's still growth, but it's slower than it used to be in previous years. Praying is a bad recipe. August, not necessarily lower volatility. Well, we had nice volatility on Friday with the Nonfarm payrolls. I think We'll have nice action with the ECB. 3 years ago in August, it was the most crazy month of the year with the downgrade of the US credit rating. So I wouldn't say August is the worst month. Volumes are a little bit lower, but it's certainly not dead. Volumes are extremely lower towards the end of December, but that actually last year caused more volatility. We had some records in a few currencies that came just by the end of the year. So it's just less predictable during December. But I think that August is generally less volume, but markets don't go dead or don't go crazy. It's just less volume, but not so dramatic. Here it's the year most dramatic. Well, September after August is stronger, of course. May, in my experience, is a good month, and basically most months of the year. But I think that from my experience in the past few years, May and September are usually the most interesting months, but also July, August, October, November, they all see nice action. Okay. Any last questions before we wrap it up? Sorry again for the noise on the street. I can show the chart again while I answer that question. Right. So what's the question? Well, next webinar depends on next week, but usually I hold them at the beginning of the month, first week of the month. Anyway, the data is published on Twitter, on my website, of course on FX Street, which I have to thank again for hosting it. Time frame. I look at the daily and hourly charts. Daily for longer term and hourly for shorter term seem like the most basic and interesting time frames. But I know many traders like 4-hour charts. So seeing the bigger picture, I would use daily charts and trying to find entry points, exit points, depending on your strategy. The hourly charts work better for me. I think that anything below that would be just too noisy. But that's a topic for a whole webinar, which smarter people than me can give on this topic. Any good books? There's so much information online. I would recommend going to the Learning Center of F Street. And there's another website called babytips.com that has excellent information for beginners. And that would be, I think, just reading article by article would be maybe more useful than buying one specific book. Yeah, thank you for this comment. You can just follow this link and follow me, and then you'll get a notification on any upcoming webinar. You're most welcome. So I'll go back to the last slide once again, which says, thank you once again, FX3. Thank you everybody for attending. Welcome to visit the website and check out the new podcast, newsletters, and have any additional questions, here are the contact details. Yeah, good night, good day, good morning, wherever you are. Thank you very much. And yeah, it's recorded, so if any of you missed the beginning, you can see it from the top. Okay, so thank you very much once again. I apologize for the noise once again. Should get it fixed next time. And see you. And have a successful trading day, week, month. And goodbye.